From DLA Piper, this is the Beyond the Curve podcast. In this episode, DLA Piper's John Sullivan, Barbara Trachtenberg, and Paul Shadle discuss the firm's recent Global Real Estate Summit and accompanying State of the Market survey and resulting report, which analyzes the views of commercial real estate experts and leaders on post-pandemic recovery, economic outlook, attractiveness of investment markets, and overall real estate industry trends and expectations over the next 12 months.
I'm John Sullivan. I'm the chair of DLA Piper's U.S. real estate practice and the co-chair of our global real estate practice. But more importantly, I've got the great fortune to be joined today by my partners and friends, Paul Shadle and Barbara Trachtenberg. Somebody told me a long time ago that the best way to succeed in business is to surround yourself by people who are smarter than you are. And that's exactly what I've done by being with Barbara and Paul today. We're going to talk about the 17th DLA Piper Global Real Estate Summit that took place in Chicago on May 17th. We had over 300 senior commercial real estate executives from the U.S. and beyond in attendance, as well as a cast of very impressive and experienced speakers and panelists. And in conjunction with the DLA Global Real Estate Summit, we released the DLA Piper State of the Market survey. And we think that the combination of that survey and the information we got from it and the discussions that took place during our global summit in Chicago provide a unique window into the challenges and the opportunities that we see in the current commercial real estate market. But before going further, I'd like to ask Paul and Barbara to please introduce themselves.
Good morning. My name is Paul Shadle. I'm a real estate lawyer in our Chicago office with a focus on development, entitlements, and public-private financing. And that informs my perspective on both the survey and what we heard from our panelists during the summit.
Hi, John and Paul. I'm Barbara Trachtenberg, a partner in our Boston office. And while having the pleasure of being a co-chair with Paul of the summit, I also practice in the area of investor side representation, representing mostly institutional investors in joint ventures, acquisitions, dispositions, and financings.
Thanks, Barbara. Thanks, Paul. Great, as always, to be with the two of you. I mentioned the DLA Piper State of the Market survey. I wonder if one of you could start us off by describing what that survey is, what the general sentiment was that was expressed by the survey results, and whether that sentiment came as a surprise to you.
I'm happy to jump in.
Great.
The survey is a survey that we've done annually for many years that we sent to leaders in the real estate industry from both clients and more broadly, those who are involved in all aspects of real estate. And we ask a range of questions to gauge what industry leaders believe is the condition of the industry, where it is, where it's going. This year, I was a bit surprised to see our respondents remain confident. And I guess the confidence itself didn't surprise me. It's the degree of confidence. So that was a pleasant surprise to see that the confidence is intensified and our respondents are not only confident, but they're more confident. I was not surprised by the asset classes around which that confidence was focused, like warehousing and distribution, multifamily housing. That was not surprising to me. We heard concerns about expected interest rate increases, inflation, and other potential impediments to development. But despite that, we heard confidence about the direction of the industry.
Thanks, Paul. Barbara, what are your thoughts?
I agree with Paul that we expected there to be confidence, but it was a different kind of confidence than people expressed in the last survey. People were much more bullish. And unlike our last survey, the pessimism, if any, wasn't fueled by the pandemic anymore. In our 2021 survey, those who were bearish, I think 35% of them cited the pandemic as the reason for their bearishness, and that was down to 7% this year, which really shows that we've come to grips with how the commercial real estate industry is going to live with COVID. At the same time, the survey did reflect that there's lingering effects of the pandemic. The increased construction costs that Paul mentioned, labor shortages, supply chain issues, these are all expected to impact the real estate industry in the next 12 months. One of the things that was noted was the expectation that GDP increases would change over the next 12 months. And that, to me, was not surprising at all. There was insane GDP growth, especially in the last 6 months of 2021, and that's not sustainable. So I didn't think that was any reason to pause for concern. It was just a reflection of naturally how GDP grows over a longer period of time.
And Barbara, I would just extend your point, and that is that not only in the survey, but in the discussions among our panelists, the responses that we saw in the survey were confirmed insofar as the pandemic is an issue, clearly, but it's an issue that the industry is equipped to contend with by doing things such as changing the way offices are built and operated. And I think we heard from multiple panelists that one of the things that the pandemic did is accelerate things that were already happening. The anecdotal feature of office development that we often hear about is amenities and changing the space to a space that people want to go to rather than a space that people must go to. And I think we heard both among our innovations panelists and our capital markets panelists that there is an appetite to do the things that are necessary to adjust to the pandemic. And again, that the industry is well equipped to do that.
I agree. And I was just going to say that it was a fascinating time to do the survey and to have the global summit because there's so much that's going on in the world in general and in the commercial real estate sector that has never happened before. And it's not that often you can say that. We've all been through cycles and they tend to be variations on a theme. But the global pandemic was maybe a variation on a theme, but it had been 100 plus years since we had seen that theme. So we were all faced with a completely new situation. And to me, it is just fascinating to think back, say, to the end of the first quarter of 2020, when the commercial real estate market had come to a virtual standstill. We've all been around long enough to have been through market cycles and ups and downs, but none of us had ever seen anything like that. And there were some people that were pressing the panic button a bit, particularly with respect to office and thinking nobody's ever going to come back to the big cities. And you all heard me say to our group at that point in time, it reminded me a little bit of the reaction after the 9/11 attacks on the World Trade Center, when there were people that said, well, that's the end of high-rise office buildings because nobody's ever going to want to be in a high-rise office building again. And of course, proved to not be the case. And I think it was a similar thing with commercial real estate. It came back, and it came back very quickly, much more quickly than I frankly would have predicted. And there are still some lingering questions, and we could probably going to talk about some of those, but the survey is evidence of the resilience of commercial real estate as a global asset class. So the survey was taken in February and March. In some ways, that's not long ago. Seems like just the other day, but with everything that's going on in the world, in some ways, it is actually long ago. We've got inflation at a 40-year high. We've got interest rates that have gone up significantly. We've got volatility in the public markets. So I'd be curious, Barbara and Paul, if we were to take that survey again today, do you think that there would be a material difference in the overall sentiment?
I'll take that one, John. When we craft these questions, we have a number of things that we're trying to accomplish. One is that we're trying to maintain consistency from year to year so that we can do some year-over-year comparisons. But we also try to craft the questions in a way that they reflect the reality of what we think is happening at the time. When we wrote those questions, we did not have Ukraine front of mind. But by the time the survey got published and continued to get answered, more and more people who were pessimistic chose other as the reason for their pessimism. And when we looked behind that as the write-in reasons why people were choosing other, they wrote in the invasion of Ukraine as the reason for their pessimism. And months later, I think that we see even more evidence of that concern. The U.S.'s humanitarian efforts, our need to support NATO countries, exporting natural gas to Europe. All of these things are going to impact us here at home financially and maybe even in terms of labor shortages, supply chain, et cetera. So I do think that it makes people a little less confident. But at the same time, in times like these, when there are problems elsewhere, when there is global political instability, a lot of that time, that's when the U.S. looks more stable, more of a solid investment. So it could actually be a benefit to the commercial real estate industry in the U.S. in the fact that people might flock to the safe haven of the U.S. for their real estate investments over the next 12 months.
And I would add, we might see heightened concern about those risk factors that we discussed earlier, interest rates, inflation, and particularly the invasion of Ukraine. But going back to the earlier point about the nimbleness of real estate, I think our panelists were pretty clear that they adjust in different ways. Our capital markets panelists were talking about better managing both the development process and then operations. And then our panelists that were addressing innovative development were talking about, to Barbara's point, the shift to other markets, other U.S. markets, but other markets outside of the gateway cities, and also to different ways to attract clients, in particular in connection with the office users. So I would say that I think the answers would be different, but really more in terms of emphasis rather than wholesale change.
That all makes sense. Barbara, you alluded to the fact that real estate is sometimes viewed as an inflation hedge. So we've been hearing a lot and reading a lot about that recently. I saw a study that said for every 1% increase in inflation, there's a slightly greater than 1% increase in total return for real estate. Those are kinds of real estate assets where you can adjust your rents with some frequency, like apartments and lodging, hopefully to keep up with inflation, maybe to maintain a little bit of margin on inflation, I think could actually benefit in this environment. Of course, increased interest rates make everything more expensive, and we've got the supply chain issues that haven't been worked out yet, and general increases in costs. And I know we heard from a number of our clients during the course of the summit that it's particularly difficult now when you're looking forward for new development, because it's hard to price what's going to be the all-in cost. So it's going to be very interesting to see how all of that plays out. And the last thing maybe on this topic, and then we can move on to something else, but for investors who have a big portfolio already, rising costs, including interest rates and costs of materials, can dampen new development, which of course can increase the value of the existing asset. So it's always a 2 or 3 or 4-edged sword. So it's going to be, I think, a very interesting next 12 months to see how that all plays out.
And that actually functions pretty dramatically in some of the gateway cities too, I think. What you just cited, John, which is that we have high barriers to entry in some of these places. I think in particular with respect in my work to multifamily housing, and the developers both have to contend with, but also are able to take advantage of that.
Right. No, that's absolutely true.
Yeah, agreed, Paul. And a lot of our clients in the 2021 survey had acknowledged that they anticipated inflation in the next 12 months. So for a lot of them, it was not a surprise that we're in an inflationary period. And that's why at the summit, we heard from a lot of speakers about investing in places like multifamily and self-storage and other asset classes where you can increase your rates on a fairly regular basis. I also think that interest rate increases will help some of the institutional investors who are lower leveraged, because they will suddenly have less competition for those assets.
That leads us to a topic that got a lot of attention in the survey during the summit, and I think is talked about often in our work, and that is speculation about the long-term impact of the pandemic, and in particular, the effect of remote working on the demand for office space. I know that we have seen it in Chicago and in this region where there's been a lot of stopping and starting. There's, among a lot of the people I work with, a desire to be back to face time in the office, both for purposes of doing business the way we always have, and also getting young people, not just those practicing law, but those involved in the development and operation of real estate, back together so that people can learn more effectively. I'm curious about what the two of you think about how the survey respondents and the speakers at the summit addressed that subject.
Yeah, there was already, pre-pandemic, this drive for amenities in office buildings. We already had WeWork. We already had conference centers and fitness rooms and grab and go restaurants. We had all of these things happening. And I think that what is continuing to happen is that the pandemic has accelerated the pace of that. Suddenly, people have options about where they're going to go to work because there's more vacancy, so they can be more demanding about where they're going to be. And what we've seen in the survey results and what we heard at the summit was that owners are responding to those demands. It's no longer just good enough to have a fitness center. It's no longer good enough to have some flex conference space. Now people are repositioning their existing office buildings to have more amenity space. They're having roof decks. They're having golf simulators in the lobby. These things are happening and continuing to happen. So I think that what we heard from a lot of people at the summit was that that Class A trophy asset that has all of these amenities already is going to continue to be in high demand. And where the potential problems are going to creep up is in the Class B and C, because there is this flight to quality. And I think we will continue to see that, at least in short term. At the same time, at the summit, we heard a lot of people saying, people need to go to work. Our newer members of the industry are not getting trained hands-on. They're not getting the mentoring that they need. And I think that is true across our industry.
And people do like to be together, and they work effectively together.
Yeah, they do, Paul. I'm glad you raised this topic because I think it's fascinating and there are a lot of divergent opinions on it. We certainly heard divergent opinions at our summit from our panelists, but one of the things about the survey that struck me was that 20% of the respondents predicted that office vacancies will never get back to pre-pandemic levels. Never. Now, I'll say again that I think it's too early in the game to make that kind of prediction. The pandemic was a black swan event, and it's very, very hard to know what the long-term impact is. And we all saw companies ping-ponging around on this subject for close to a year. A lot of the tech companies at first saying, oh, you never have to come to work, and then you have to come to work, and everybody's trying to figure it out. I do agree with Barbara's point that we have to be careful about making generalizations when it comes to office, because there is new office that's amenity rich, that's ESG friendly, and we're still seeing demand for that. We saw the trade of about half of the equity in One Vanderbilt in New York purchased by Blackstone. You see Google and Facebook have both recently made very significant real estate commitments in major cities. I think there'll be some winners and there'll be some losers, but I think it's too early to call the ball on it. And I do agree. I think people like to be together.
Well, in our government work, too, where we're seeking entitlements for developers, we are talking a lot with those who are tasked with managing large cities and their planning. And I know for a fact that in Chicago and New York, at least, to go back to the theme of accelerating things that were already happening, the shift from B and C class buildings to A class buildings is not new. It's been happening for a long time in cities, as long as I've been working. And we're seeing that magnified right now. And I know that, again, at least Chicago and New York are focused on how do we repurpose buildings. In Chicago, for example, on LaSalle Street, which was the focus of business activity in the city for many years. Downtown and on Wall Street in New York, they're contending with the same issue. How do we convert these buildings? And that's what real estate entrepreneurs do.
And then the last thing I'd say on the office, because you're right, it's really difficult to act in generalizations. One of the things that struck me from the survey was that the respondents thought that suburban office was going to rebound faster than urban office. And that, to me, I would not have expected that at all. I think that the big cities are going to rebound. They're going to rebound strong. We've already seen that multifamily rents in New York City are back to pre-pandemic levels. I was really struck that people thought that was going to happen quicker in the suburban areas. Now, maybe vacancy rates were higher in suburban areas. Maybe they think that people are looking to work closer to home now. It'll be interesting to see how that shakes out. All right. So speaking of the survey, the key takeaways was that Sunbelt markets ran the table in terms of the most desirable places to invest. In fact, Austin topped our survey once again as the most attractive investment city in the U.S., with 60% of respondents citing it as a top U.S. city for investment. So my question for the two of you is, did that surprise you that the Sunbelt markets are continuing to have such strength in numbers for U.S. investments? And what do you think that means for the future of traditional gateway cities and other big areas? In our most recent survey, investment in San Francisco and Silicon Valley combined was down to 12%, which to me was a surprising number. So let me know what you think about that.
I can start. I wasn't shocked by the degree to which the survey respondents favored Austin, Nashville, Raleigh. I expected that. But I also think that there was clear commentary among our panelists at the event that while they are focusing their attention on those places and investment is happening in those places, that doesn't mean that they're abandoning the gateway cities, and that the gateway cities still have a lot of strength to the extent that they can maintain and grow population. So I wasn't surprised. Our panelists were clear, and our own client work confirms the gateway cities are and will continue to be key markets, but there will be work to do to find the right projects there, that it won't be as easy as it has been.
Paul, this is another example, as you pointed out, of things that were happening before the pandemic that continued and in some ways maybe got a bit supercharged or propelled by the pandemic. So we had been seeing this trend of increased interest in so-called Sunbelt cities, using that term fairly loosely. We've been seeing that before the pandemic, but then you untether workers from the physical location of their office. And I think more people started to say, well, maybe particularly if it's winter in Chicago or somewhere in New England, why am I here when I could be working from someplace else? So I agree with you, Paul, that it wasn't a surprise to see that response in our survey. But I also agree with you that it's not as if we are going to see the death of the urban core in our major cities. I personally am a big believer in the urban core. I think, as one of you said earlier, people like to be together. And the world-class cities, to name a few, New York City and Los Angeles and Chicago and London, I think that they're always going to be places where a lot of people are going to want to live. Barbara noted that residential rents in New York City are back to pre-pandemic levels. So people definitely want to live in those places. I think that the biggest challenge to some of our major urban areas is not what a lot of people are talking about. I think it's not the impact of the pandemic and the remote working phenomenon. Not that those aren't important, they are. I actually think that the biggest challenge is political and socioeconomic. But that's probably a discussion for a whole separate podcast.
Well, one comment, though, because I agree with you, John. I do think it's worth noting that is essential in our work. And again, we heard this from our clients on the panels. It's not just the developers themselves that have to adjust, but it's also the leaders of these large metro areas and the core municipalities in particular, where someone like me, and I'm not an anti-regulatory person, I worked in government before I became a lawyer, but we contend with processes for entitlements that are prohibitive in some cases. And at the same time, as the places that are imposing those processes see a dramatic demand for more housing. And we talked earlier about how barriers to entry are both an opportunity and a barrier, but they do stop much needed development. So the government actors are going to have to adjust in order to operate a review process that, of course, protects the public, but also facilitates new capital investment in these cities that need it.
I think those are good points. And looking at it, flipping it over to the perspective of the cities that are experiencing this growth, the Sunbelt cities, it's a blessing mostly, but it's a mixed blessing sometimes. The growth that those cities are facing is creating a strain on municipal services. It's raising housing prices and all that. Now, I'm sure if you ask the mayors and other political leaders of those cities, which would you rather have to deal with, a lot of growth or not enough growth, they would all opt for growth because that's what everybody wants. But it's not as if that's without its challenges as well. The final thing on that point, Paul, just to pick up on a comment that you made, is the cost of housing. They've gone up so dramatically, and now it costs even more to buy a house because almost everybody has to borrow some of the money to buy a house. So that's gotten more expensive, and that's going to, I think, create some challenges for a lot of the U.S. cities.
Agreed, and will likely lead to further increases in rental rates. As we've seen multifamily rebound, the flight back to more rentals that we had all become accustomed to pre-pandemic, I think will return once those interest rates make it cost prohibitive for people to enter the single-family market. We've talked about some aspects of the survey that were not entirely as predicted, but is there anything other than what we've talked about before that you'd like to mention that was particularly surprising to you as a response in the survey?
I'll return to a theme that we've discussed a bit, and that is how shocking it was to me that there is a belief, at least by 28% of our respondents, that office growth, when it does return or return to the office when it happens, is more likely to occur in the suburbs than in center cities. And I'm surprised by that because anecdotally, we're not really seeing that in our work. Where office development is happening most intensely, and I think this is true not only in the traditional Midwest and Northeast cities, but elsewhere, where office development is happening, it is more in the core than in the suburbs. And it may be that the issue that you raised, Barbara, about vacancy rates being so high in the suburbs to begin with is coloring that. If it's really just the suburbs versus the core cities for those users of office space, then it's a little bit confounding to me that our panelists suggested that the suburbs are favored over the cities, because it seems counterintuitive and it doesn't seem to be borne out by the activity that we're seeing. So that surprised me.
Yeah, I hadn't actually really focused on that, Paul, but I think it's a good point, and I agree with you. That is a bit surprising. So one thing that surprised me was that only about a third, or maybe a little less than a third, of the respondents said that ESG is likely to be a top priority for them this year, because that isn't consistent with my own experience and the clients that I work with, mostly institutional investors, where ESG is a very important thing to them. And I think at the summit itself, most of the panelists who talked about this talked about it as being quite important. A number of them mentioned that it is part of their formal investment approval process, just as you've got to provide rent comps and replacement cost information and market studies. You have to provide ESG related information as part of the investment approval process. So that response surprised me a little bit. And talking to our colleagues in Europe, that the U.S. maybe in general is lagging behind a lot of the European countries with respect to the focus on ESG. But I think it's going to continue to be important and more important in the U.S. So a little bit surprised at that survey response.
John, I agree with you on that. Many of our panelists spoke about their companies having net neutral targets in the very near future, which would suggest to me that ESG has to be top of mind. Perhaps the sentiment there was more closely related to the fact that we put a 12-month window on it.
I agree with you, Barbara. And we heard from both our real estate live panelists who were focused on climate change, ESG, and sustainability, and then our deal making and other panelists about how important ESG is. So I agree that the panel discussions at least seem to suggest that that is an important issue. And we heard concern about greenwashing, for example, from developers who indicated that they want ESG substantively to be a part of their development, and also that their lenders are requiring it. So it comes into the underwriting process as well as the execution process. In particular, we heard from one of our clients that is an office developer and operator. He believes that systematic adoption of building efficiency measures is going to be part and parcel of development and operation going forward.
Yeah, to your point about people demanding it, we know that tenants are asking landlords what is available and asking them to live up to higher standards than they've been asked to do before. We also know that investors are demanding it as well when they're deciding where to put their capital. But we also heard Ben Myers from BXP say that they're doing it not just because it's the right thing to do, but because it's good business. They saw their decrease in operating expenses as a direct result of the investments that they were making, and it has become good business.
And it makes perfect sense in an atmosphere in which we're discussing controlling costs and dealing with rising interest rates and so forth.
Yeah, it does make sense. And just to echo what both of you said, it's important to investors, it is important to tenants, users of buildings. And the only thing I would add to that is it's important to the communities in which these buildings exist. That's one of the things about commercial real estate, is being part of the built environment. And Paul, this is the world that you live in. It is part of the fabric of communities. So having good relationships with the people who live near your investments, with the governmental officials that have some degree of oversight of your investments, that's all critically important. So it seems to me no matter what angle you look at it from, ESG is going to be something that's going to get a lot of focus in the upcoming years. So I think this has been a great discussion, and maybe I'll wrap it up by asking what's probably not a fair question, but I'll do it anyway. So fast forward to a year from now, what will be happening in the commercial real estate market that will make you or other people say, gee, didn't see that coming?
This returns to a theme that we've been discussing in this conversation quite a bit, and it won't surprise you because I do a lot of work in urban economic development for our clients and entitlements. But I expect that we will see a year from now a dramatic resurgence of activity in traditional central business districts. And it's a little bit like a broken record. But again, our panelists noted, and we see it in our own work day to day, people like to be together, and they like to be together in high quality spaces. So I think we'll see this activity in central business districts, but also with a focus on the areas that are different. And in Chicago, that might be Fulton Market. In New York, it might be downtown, or it might be the meatpacking district. But areas that are attractive in terms of entertainment and activity will continue to be attractive, and they're going to be more attractive. So in a year, I think our central business districts are going to be thriving.
How about you, Barbara?
Well, that's a prediction that everybody likes, right? Look, for me, it's what is something that could happen that we don't anticipate today, right? We heard a lot at the summit about expectations for midterm elections. If midterm elections went a different way and Democrats end up in power in both the House and the Senate, I think we would see significant changes in policy in DC. And the effects of that in commercial real estate are unknown, but I think that they would, as they usually do, impact commercial real estate. So that's something that could happen. It's not something that I would say will happen. I do think that hopefully over time, inflation will settle. But if it didn't, that would be another unexpected event. I think that when we saw all the stimulus that was being put into the economy in 2020 and 2021, we kind of anticipated that long-term that would result in some period of inflation. I don't think we thought it would be sustained inflation. So if it continues at the clip it's going, I think that would be a surprise and it would have a significant impact.
Well, I guess turnabout's fair play, so I'll throw my own prediction out there. It's actually similar to Paul's in that I think that a lot more people are going to be back to the office in the urban cores a lot faster than any of us are predicting today. So we'll see about that. One of those ancient Greeks, I think it was Aristotle, said 2,000 plus years ago that man is a social animal, and I think he had it right. We should wrap it up now. Barbara, Paul, thanks. It was a really interesting, informative, and as is always the case with the two of you, fun discussion. So thanks for taking the time to do this.
Thanks, John. Thanks, Paul.
Thank you. Thanks, John. Thanks, Barbara.
Thank you for listening to DLA Piper's Beyond the Curve podcast. All information, content, and materials contained in this podcast are for general informational purposes only. This podcast is intended to be a general overview of the subjects discussed and does not create a lawyer-client relationship. Statements and opinions are those of the individual speakers and participants and do not necessarily reflect the policies or opinions of DLA Piper LLP US. The information contained in this podcast is not and should not be used as a substitute for legal advice. No listener should act or refrain from acting with respect to any particular legal matter on the basis of this podcast without first seeking legal advice from counsel in the relevant jurisdiction. This podcast may qualify as lawyer advertising, requiring notice in some jurisdictions. Prior results do not guarantee a similar outcome. DLA Piper LLP US accepts no responsibility for any actions taken or not taken as a result of this podcast.